Hey everyone! Welcome back to the channel. I'm Chloe William, and today we're busting some of the biggest investing myths that might be costing you money. Let's be real, the stock market can seem like a jungle, right? Tons of confusing jargon, complicated strategies, and let's not forget those scary headlines that make you want to hide your money under the mattress. But here's the truth. Investing doesn't have to be scary or complicated. In fact, some of the most common beliefs about investing are flat out wrong. And these myths could be holding you back from growing your wealth and achieving your financial goals. If you're serious about building wealth in the stock market, you need to avoid these mistakes. Make sure to hit that like button and subscribe so you don't miss out on more investing insights. Let's dive in. Okay, let's tackle this myth head on. You absolutely do not need to be rolling in dough to start investing. Have you ever heard the saying, "It takes money to make money"? Well, in the world of investing, that's just not always true. Think back to when you were a kid and you'd put your allowance in a piggy bank. A few dollars here, a few dollars there. It might have taken a while, but eventually those small amounts added up. Investing is kind of like that. But instead of a piggy bank, your money is working harder for you in the stock market. Thanks to amazing platforms that offer commission-free trading and something called fractional shares, you can literally start investing with the price of your morning latte. Seriously, we're talking as little as $5. Gone are the days when you needed thousands of dollars just to dip your toes into the market. Now, I know what you might be thinking. Chloe, what can I possibly achieve with just a few bucks? And that's a fair question. But here's the magic of it all. Compound interest. It's like this snowball effect where your money earns interest, and then that interest earns interest, and so on. It might sound slow at first, but trust me, over time, even small, consistent investments can grow into something pretty amazing. So ditch that outdated idea that investing is only for the wealthy. The truth is, the earlier you start, the more time your money has to grow. So let's get you in the game. All right, let's talk about risk. I get it, the stock market can feel like a roller coaster sometimes, with its ups and downs. And yes, there will always be some level of risk involved. But here's the thing. Stocks have historically outperformed other asset classes like bonds or cash over the long term. Think of it like this. Imagine you're on a ship sailing across the ocean. Sure, there might be some waves and storms along the way, but if you stay the course and keep your eyes on the horizon, you're much more likely to reach your destination. Investing is similar. There will be short-term fluctuations, but if you focus on the long game, you're more likely to weather the storms and come out ahead. Now, how do we manage that risk? The key is diversification. Instead of putting all your eggs in one basket or betting everything on one stock, you want to spread your investments across different companies, industries, and even asset classes. A great way to do this is with ETFs or exchange-traded funds. Think of them like baskets of stocks. One popular ETF tracks the S&P 500, which includes 500 of the largest U.S. companies. By investing in an S&P 500 ETF, you're essentially spreading your risk across those 500 companies. Pretty cool, right? Remember, investing isn't about getting rich quick. It's about making smart, informed decisions and staying the course. History has shown that patience and long-term investing pay off. Let's talk about one of the biggest misconceptions in the investing world: timing the market. How many times have you heard someone say, "I'm waiting for the market to drop so I can buy low," or "I'm going to sell now before the market crashes"? Here's the truth. Trying to predict short-term market movements is like trying to predict when lightning will strike. It's incredibly difficult, even for the most seasoned investors. Even the pros with their fancy algorithms and charts don't get it right all the time. So instead of trying to time the market, focus on time in the market. The longer your money is invested, the more time it has to grow and compound. Remember that snowball effect we talked about earlier? The more time you give it, the bigger it gets. One strategy that can help you avoid the stress of market timing is dollar cost averaging. It's a fancy way of saying invest consistently over time. With dollar cost averaging, you invest a fixed amount of money at regular intervals, regardless of the market's ups and downs. This strategy takes the emotion out of investing and helps you buy more shares when prices are low and fewer shares when prices are high. It's a simple but powerful way to build wealth over the long term. Chapter 4. Myth number 4. More trading equals more money. Let's talk about another myth that can really hurt your portfolio: the idea that more trades equal more profits. It's easy to get caught up in the excitement of buying and selling, especially when you see those stock prices moving up and down like a roller coaster. But here's the thing. Frequent trading can actually do more harm than good. Think of it like this. Every time you buy or sell a stock, you're usually paying trading fees or commissions. Those fees can eat into your profits, especially if you're trading frequently. It's like paying a toll every time you want to drive down a certain road. Eventually, those tolls add up. Not only that, but frequent trading can lead to impulsive decisions. You might be tempted to buy a stock just because it's going up, or sell a stock because it's going down, without really thinking about your long-term investment strategy. Some of the most successful investors, like Warren Buffett, advocate for a buy-and-hold approach. They find great companies with solid fundamentals and hold on to those investments for years, even decades. They understand that true wealth is built over time, not overnight. So instead of trying to time the market or chase quick gains, focus on finding quality investments and holding them for the long haul. Remember, slow and steady wins the race. Chapter 5. Myth number 5. Investing is only for financial experts. Okay, let's debunk this myth right now. You absolutely do not need a fancy finance degree or to be a Wall Street whiz to be a successful investor. Investing is for everyone, and it's more accessible now than ever before. Think about it. We have so much information at our fingertips these days. From YouTube channels like mine, Wink, Wink, to educational websites, investing apps, and even good old-fashioned books, there are tons of resources available to help you learn the ropes. Don't be intimidated by complicated jargon or fancy financial models. Start with the basics. Learn about different asset classes, understand risk tolerance, and explore different investment strategies. There are even apps designed specifically for beginner investors that make the process super simple and user-friendly. Remember, investing is a journey, not a sprint. It's okay to start small and gradually increase your knowledge and investments over time. The most important thing is to take that first step and start learning. And hey, if you're watching this video, you're already on the right track. So keep asking questions, stay curious, and don't be afraid to make mistakes along the way. That's how we learn and grow. Chapter 6. Myth number 6. Past performance guarantees future success. Let's talk about one final myth that can trip up even experienced investors. The idea that past performance guarantees future results. It's tempting to look at a stock that's been skyrocketing and think, if I had invested in that a year ago, I'd be rich. But here's the thing. Past performance is not always indicative of future returns. Think of it like this. Just because a sports team won the championship last year doesn't mean they're guaranteed to win again this year, right? Things change, players change, and the competition evolves. The same goes for companies and the stock market. A company's past success doesn't automatically mean they'll continue to perform well in the future. New competitors might emerge, consumer preferences might shift, or the overall economy could take a downturn. There are so many factors that can influence a company's future performance. So, instead of solely relying on past performance, it's crucial to do your research and understand the fundamentals of a company. Look at their financials, their management team, their competitive landscape, and their overall industry outlook. Remember, investing is not about gambling on past winners. It's about making informed decisions based on solid research and a long-term perspective. Outro. There you have it. 6 big investing myths busted. Which one surprised you the most? Let me know in the comments. Remember, investing doesn't have to be intimidating or complicated. By understanding the truth behind these common myths, you can make smarter decisions and start building your financial future with confidence. If you found this helpful, give this video a thumbs up, subscribe for more stock market insights, and hit that notification bell so you never miss an update. Thanks for watching and happy investing.